Good morning, everyone. I'm Vince Smith, Director of the AEI Agricultural Studies Program and non-resident AEI Senior Fellow, which means I'm old. It is a genuine pleasure to welcome you all, both in the AEI auditorium and online, to today's panel discussions of the issues that surround the US federal crop insurance program, which in most years is the most costly form of federal farm subsidy delivery. The discussion will be moderated by Jerry Hagstrom, the creator and editor-in-chief of the Daily Hagstrom Report, and for a long time, the leading journalist on agricultural issues at the National Journal. The panel consists of 4 exceptionally knowledgeable members. Dr. Joseph Glauber, formerly USDA Chief Economist, is currently an AEI non-resident senior fellow and a senior fellow at the International Food Policy Research Institute. Dr. Roger Cryan is the Chief Economist at the American Farm Bureau Federation and has for a long experience with agricultural policy, both in the area of the dairy industry and beyond. And we're very grateful to be able to have him with us today. Dr. Barry Goodwin, also a non-resident senior fellow at AEI, is the William Niels Reynolds Professor in the Department of Agricultural and Resource Economics at North Carolina State University and past president of the American Agricultural Economics Association. Dr. Stephanie Mercier, our 4th panelist, is the principal of Agricultural Perspectives and former chief economist for the Democratic staff on the Senate Agricultural Committee. Before we begin, for those of you live streaming the event, as you wish to submit questions to the panel, you can do that in 2 ways. Please send your questions either by email to Benjamin, B-E-N-G-A-M-I-N, Goren, G-O-R-E-N, at aei.org, or via Twitter to hashtag AEI Farm Bill. Don't hesitate to send those questions in at any time during the panel discussion. You don't have to wait to send those questions in until the panel is opened up for questions from the floor. With that, I look forward, and I hope you all look forward to a really interesting discussion of what is widely viewed as a critical and often controversial agricultural policy. Jerry, you're in charge.
Thank you. Thank you very much, Vince. And I'd like to thank AEI for inviting me to moderate this panel today. I want to tell the audience, both here and the ones who are online, that this is going to be a discussion of the most complicated, arcane, and important federal farm program. For those of you who read the Hagstrom Report, you may often see that I run features on food at the bottom of my report. And I'm going to tell you that I started doing that because I was at a crop insurance convention in Palm Springs, California, and I was listening to a lecture on actuarial soundness of the program, and I thought, there must be more to life than this. And so I Googled what's going on in Palm Springs, and up popped this thing called Modernism Week, the celebration of mid-century modern architecture. And that's how I started covering parties and embassy events, etc. But I want you to know I still had to listen to the lecture on actuarial soundness, and I had to write about it. And I feel the same way about you watching this program today. If you are serious about agricultural policy, you must understand the crop insurance program for both its benefits and its liabilities, and I urge you to stick with us through this next hour and a half. So with that, I'm going to ask each of these panelists to give what Vince Smith calls their 30,000-foot view of the program. And we will start with Joe Glauber.
Great, Jerry. And if that sounds like a good benefit of the crop insurance program, it got you out looking at scenery and things like that. I'm going to make three major points, and then if I have some time, raise some concerns. But I think one is just the growth of this program. It's just amazing. I first started looking at this program 40 years ago, and it was nothing. I mean, still significant, don't get me wrong, but you're talking about roughly 100 million acres enrolled in the program. There's now almost 500 million acres, so fivefold or 5 times the amount that was enrolled then. Premium volume now is almost $18–20 billion. I mean, just incredible growth, and it's expanded. Only about 25% of area was enrolled in the program in the late 80s. Now it's close to 85–90% across the board, looking at field crops, row crops, specialty crops. Two, the second point is on the program's progressed a lot in terms of actuarial performance. It was a program that during the 80s and 90s ran a loss almost every year. And yet, as participation increased in this program, there was more and more data. Rate making improved. All the actuarial soundness that Jerry fears actually came into the program, such that over the last 20 years or so, if you look at full premiums divided by total, or indemnities divided by total premiums, that includes the subsidies, you're talking about a loss ratio that's well under 1. And so dramatic progress in that regard, but at a cost. And the cost is, of course, those premium subsidies. The program now approaches about $10 billion annually and is projected to be at roughly $9–10 billion over the next 10 years. That's part of the success of the program in one sense, but it is, as Vince said, the single largest program. And I think there's some concerns with that. Roughly 35% of that, by the way, goes to the private sector for delivery. Let me raise 2 quick concerns, and I'm sure we'll get into a lot more issues later. But one is, what is concerning me is the growth of the program into areas that I think may be not so appropriate for subsidized insurance products to handle. I sat on the board of directors for the Federal Crop Insurance Corporation for about 7 years. And what we always tried to do in the board is when new products came in, we were careful to say, wait a minute, that's already available in the private sector. We don't want to crowd out those products by bringing in a new product that the government now offers and subsidizes. So, that extends to a lot of things. I mean, price protections available on futures and options exchanges. Producers can forward contract. Yet we've long had these programs that guarantee revenue and price indemnify losses at the higher of the market price or the current price. So a lot of option components. I have less problem with offering those products, which I think producers, they've been very popular. Producers clearly want those products, but the question is, should we be subsidizing the price component of that? I'm particularly concerned about livestock because I think there's an issue where there's a lot of contracts out there, and there is some evidence that as we've started to subsidize those products, that you do have some instances where producers have been essentially harvesting those subsidies by taking offsetting positions in futures contracts. And then lastly, and I think we'll get into this a little bit more, is the other thing is I think that insurance is a risk management tool. At least I think by adding in other program goals like improving climate or trying to address conservation issues and things like that, those are all laudable goals. I just don't think we should undermine the actuarial integrity of the program by putting in add-ons and other sorts of things. I think if you want to subsidize those things, and that's a whole separate debate, then we ought to do it directly and say, okay, we want cover crops, then let's subsidize the use of cover crops. Don't go into the undermining the actuarial performance of the program. Jerry, that's it.
All right. Roger?
Well, here on not having add-ins in the crop insurance program, it's pretty important, I think, that the program do what it's supposed to do and not get burdened with a range of programs beyond that. The title of this session is Crop Insurance and Disaster Assistance, so I'll say a couple of words about disaster assistance. As it operates today in an ad hoc form, it is slow and unreliable. Producers wait a long time. to get paid. They don't know if they're going to get paid. I've heard of farmers who've invested on the basis, on their assumption that they're going to get disaster payments, and those payments never came. So there's something to be desired for those. They're also, of course, relate back to, to the crop insurance. There's a sort of a duplication of effort. We don't, at one point, disaster assistance was briefly tied to participation in some sort of crop insurance or non-insured assistance program. And as the crop insurance program grows, it becomes more and more feasible to make that the focus of covering losses. In particular with crop insurance, it's a top priority at AFBF. As Joe said, it's grown enormously. It is really, at this point, the core of farm programs, along with some of the Title I programs. Crop insurance is remarkable for its ability to reach those corners and those nooks of agriculture that aren't covered with other programs. The ability to develop new products, as Joe was discussing, new insurance products in the years between the Farm Bill means that if something's missing, you can do it anytime. You don't have to wait for the next Farm Bill to fill in a gap. We think it's really important that we have no reduction in the premium share, in the cost share for the government's cost share of the program, crop insurance is a growing, evolving program. It fills in the gaps. It is self-correcting over the years. If a crop insurance product doesn't pass the red face test, it gets revoked or revised until it does. The actuarial soundness of the program isn't a joke. Some folks think that if the producers aren't paying the full premium, that it's not actuarially sound. I disagree with that. The public is paying a share of that because the public has benefits from that participation. It is an important risk management program for farmers. And I think it's important to recognize if you want farmers to keep farming, you got to help them get through this year if you want them to farm next year. A lot of folks will say, well, other folks will take over those resources and farm. And my answer to that is, if you don't have a good solution for ag labor, I don't know that that's necessarily the case, because there's an awful lot of row crop farmers who are doing their own work and would have a hard time continuing if they had to hire somebody else to do it. So it is important to food security, domestically and internationally, that we support productive agriculture with programs like crop insurance, that we make sure that, as Joe sort of alluded to, that conservation programs don't shut down production, and that we do everything we can to support farmers who are supporting all the rest of us.
Stephanie.
Yep, thank you, Jerry, and thanks to AEI for holding this event. So I want to provide a little bit of historical background on the program. Crop insurance as an actual program has been around since 1938. It was part of the original array of farm programs back in the New Deal era. But the original program didn't work very well, and it was actually phased out for a couple of years during the course of the Second World War, and then it got brought back. But it didn't really become kind of a national, broadly available program until 1980. And at that point, in subsequent legislative efforts, major goal of the program, practically on the part of legislators, is that they wanted to create a program that was robust enough to attract farmers to reduce the demand that they seem to get every year for these ad hoc disaster programs that Roger mentioned. Decision to start subsidizing premiums that started in 1980, that the share of the federal government share of that premiums kept growing steadily. I think it's now over 60%. Some important watersheds along the way that we've seen in the last few decades that have contributed to the size of the program. Joe mentioned the treatment of the price component of a revenue product being subsidized. That was a decision that was made in the course of the Agricultural Risk Protection Act of 2000, which occurred when I was on the Senate Ag Committee staff. So that was a watershed, made those kinds of products get equal subsidization to the yield component. And then the other piece that made the acreage grow so much was the development of policies to cover pasture and rangeland, which has been responsible for a big share of the acreage increase over the last few decades. Crop insurance, especially the revenue component, is now a fundamental piece of the farm safety net. And in fact, I looked at the most recent CBO baseline, which came out back in February. And over the next 5 years, CBO projects that the commodity program portion of the farm safety net will be average under $5 billion a year over the next 5 years. But the crop insurance, cost of the crop insurance program over that same period will be roughly $11 billion, so double what's being put into transfer payments under the commodity program. So obviously, this is very important to the farm groups. Obviously, as Joe mentioned, also very important to the industry that it stay as a fundamental piece of that safety net, because it's frankly quite lucrative for them. And efforts to make serious dents in the cost of the program have not been successful in Congress. There's very strong support for these programs in Congress. In fact, I noticed as I was going through the omnibus bill last December that there was a provision in the ag portion of the omnibus which gave $25 million to the crop insurers to make up for what they otherwise would have lost under the standard reinsurance agreement in terms of their A&O, which is administrative and overhead expenses. So very, very strong support for the programs and how they currently operate on Congress. So major changes are unlikely to happen.
Thank you very much, Stephanie. Barry?
Yeah, well, I think my role here is to comment on what we've heard here today, and I have, I guess, a bit of a contrarian view on things. Let me say, first of all, Joe pointed out the improvements in the actuarial science, and Jerry alluded to that as not being that exciting of an issue, but I think RMA has made some remarkable progress there in terms of bringing the science to bear on these issues, and there is a great deal of accuracy there, and it's come as a result of a lot of engagement in government and the academic communities and the industry. So there's a lot happening there. Joe and I think Stephanie alluded to this this tension between ad hoc disaster relief and crop insurance. And I remember back, I've been doing this for a while now, and I remember back when crop insurance was supposed to be the replacement for ad hoc disaster. We weren't going to do disaster payments anymore. You had to buy insurance. That did not stick at all. I mean, whenever there's a bit of a disaster somewhere, I think Congress is very, very quick to get the checkbook out and rush in. And Joe mentioned this, and this is one thing I've struggled with for a long time. I've always viewed government programs, as to be here to fill a gap that the private market hasn't filled, at least some failure of the market. And we could debate whether that exists here or not, but Joe mentioned the fact we have private insurance markets for price in the place of options markets. That is just an insurance contract on price. And I've been rather amazed, just as an observer, that we've come in and subsidized options, well, not options, but providing the equivalent coverage through revenue protection. So clearly there's a crowding out that takes place when you do that. There's been a debate among a lot of us, could we have private crop insurance? I think we could, actually. It's not going to be anything like what we have now, but there's no way in the world that any private entity can compete with a 65% plus the operating subsidies. There's no way. And any effort to try to bring to bear some of the innovation in financial markets is going to fail because you just cannot compete against this subsidy. It's just not possible. And we always ask the question when we think about ag policies, what are we trying to accomplish with this? And Roger pointed out a popular view that this is needed to ensure the stability and availability of our food supply. And, the counterfactual to that is, would we have a stable food supply without crop insurance? And I think we did prior to this program expanding to such an extent. So, and I always bring up, all of us have been enjoying our coffee this morning, and we don't want to depend on foreign markets for something that's essential like our food, but we do for our coffee. I mean, where would we be without that, right? So I'm not convinced that that we would starve to death without these programs necessarily. Let's see. Stephanie pointed out the 1980 Act as being really what resurrected this program. It came out of a campaign debate back between Roosevelt and Landon, I believe it was, back in the 30s. Really, one thing I point to that with a bit of fascination is ARPA in 2000. This provided a lot of things, but it provided this incentive for developers.
Please tell them what ARPA was.
ARPA, I'm sorry, Vince cautioned us on that. The Agricultural Risk Protection Act of 2000, which really was a landmark legislation as crop insurance is involved, or pertains to crop insurance. It gave rise to a process called the 508H that is referring to the federal code, but it provides a process for private developers to innovate and come up with ideas for private plans, and RMA, the Risk Management Agency, and Federal Crop Insurance Corporation have to consider those. And I think has really given rise to this huge cottage industry of developing plans that really don't have a lot of need. They probably cost more to develop and maintain than they ever generate in premium. I could think of some examples with that. But you know, there has been this rush of private industry to soak up some of the crumbs that are falling on the floor here, and I'm not sure that's really the best use of our revenues, government revenues. I think I'll stop with that. There's a lot to say. Cover cropping's been a major thing. Stephanie may talk a bit about that here as we go. And I'd say we had an event here a few months ago where we talked about cover cropping, and it's, cover cropping encompasses so many different things that we don't really understand. And as Joe said, it doesn't maybe make a lot of sense to try to leverage or wedge one benefit into a program that's doing something else entirely. And I would remind you one last thing. Vince and I did research many years ago that pointed out that a lot of times, a lot of these programs that we have in the Farm Bill are really working against each other. And an example is our conservation programs that are meant to address soil erosion, put land in reserve, and so forth. And we, at the same time, are increasing subsidies for crop insurance, which when you subsidize risk protection, you are subsidizing risk, which leads to more risk. It leads to production on lands that might otherwise not be in production. And so I think you need to think about whether we have offsetting programs that are just generating a lot of funds and deadweight losses. So I'll stop with that, Jerry.
All right, thank you. Thank you. Now I'm going to try to ask some questions to provoke more discussion, but I'm going to point out a couple of things before I do that. The first is, as has been alluded to during this discussion, crop insurance is not actually authorized in the Farm Bill. It was authorized by these 1980 and 2000 laws, is that right, Stephanie?
Well, the underlying authority is from 1938.
Oh, from 1938. Okay, and so therefore, it isn't it isn't a topic in the Farm Bill the same way that a lot of other programs are, but there have often been changes to the crop insurance program, including reallocation of funds. That's very important to the crop insurance industry. Now, my reporting this year shows that the crop insurance industry is one of the few, if not the only sector that has not actually issued a paper saying what they want out of the Farm Bill. Now, when you talk to them privately, what the lobbyists will say is that they want the program to be continued, they don't want it to be damaged. But their biggest concern is the talk of establishing a permanent a permanent disaster program. Now, I understand as a reporter the pressures for a permanent disaster program, because there are things that crop insurance does not cover, and a lot of the pressure for the disaster programs have come from things that were not covered, particularly in with storage of grain and things like that. So I'd like to ask the panel what their views are on a permanent disaster program, and also how it would intersect with crop insurance. The big deal for the crop insurance industry is they don't want any permanent disaster program that would discourage the farmers from signing up for for crop insurance, because, to use my not hated, but the term that I get tired of writing about, is that would cut into the actuarial soundness of the program, because the program is more actuarially sound with more farmers and more acreage participating in it. So, views on permanent disaster programs and whether there should be one or not. Stephanie.
Yeah, so this is an old story on Capitol Hill. The last time there was a serious effort to establish a standing disaster program was, I believe, the 2008 Farm Bill. And we actually put in a package of 5 different provisions which made up sort of the standing disaster program. And 4 of them are still there. There's one for livestock mortality, for forage, for tree crops, and this sort of grab bag one that provides assistance for things like aquaculture and things like that. Yeah. The other one was the acronym was SURE, which is Supplemental Revenue Program, which was designed to complement the crop insurance program. And that went into place in 2008. And the way it was designed made it actually much slower than crop insurance. And in the book that I wrote a few years ago on ag policy, we quoted officials of the Farm Service Agency who said that it was the most complex program they'd ever tried to implement in their careers. And when got to the 2014 Farm Bill, and I was gone from the Ag Committee by then, that program was not renewed because it had been, in part because the way they decided to calculate the relevant prices for the program, it actually meant that you didn't get funding, a payment under that program until well after the event. So it was actually in some ways worse than an ad hoc program. I know there's a strong desire, especially I know the ranking member on the House Ag Committee, Mr. Scott, is an interest in standing disaster program. I don't know what they're looking at in terms of the design that would actually make it quicker and easier, because the SURE program obviously did not meet those objectives back in 2008.
Yeah, one thing I will say is that Barry said Congress was quick to get the checkbook out. What the farmers would say is they got the checkbook out, but it wasn't quick. That's one of the complaints about the disaster programs, that it takes them so long to get the money. Other comments?
Yeah, I mean, everyone's mentioned the fact that particularly in the early years of the reform program, I mean, post-1980, that there was always this trade-off with disaster assistance and crop insurance. And for the 2007, which became the 2008 Farm Bill, because Congress couldn't pass it in 2007, I was on an event here at AEI, and I wrote a paper called Double Indemnity, and it was essentially about the fact that farmers were getting 2 payments for each loss, because they would get, those who were insured would get their payment, but then Congress would come in and pass an ad hoc disaster bill, and the last thing they wanted to do is penalize those who purchase crop insurance, so they'd pay them too. And so very costly. And I keep getting back to the fact that we have almost 500 million acres enrolled. So who isn't in the crop insurance program right now? So why is there a need for a permanent disaster program? 1, 2, the bothersome thing that I see, and Stephanie alluded to it in the 2008 Farm Bill, are all these additional coverages. I mean, farmers can insure up to 85% of their loss right now for most field crops. Do we really, 95 in some cases,
and get the
do we
premium
really want
subsidized?
them?
Yeah.
I mean, there is some sharing, I think, risk sharing here that needs to take place.
Yeah, and I just say, quick is relative. I think back to the I was new to this and learning about ag policy, and I think back to the FAIR Act of '96 and what a lot of us thought, I guess rather naively, that was a sign. It was a transition to the marketplace, if you remember that, right? I mean, and we had these fixed payments that were going to decline each year. I thought, wow, this is a buyout. Obviously, we're going down the path economists have been pushing us to a long time. And then we had, and that was when times were good. And then in about 98 or so, things turned bad, and Congress did move very quickly. Now, the checks may not have gone out that fast, but right away, we had market loss assistance. Ad hoc disaster, which I think was pushing $30 billion by the time it was over with.
Yeah.
They do move, and this was in the face of trying to grow a crop insurance program at the same time. You know, it's a puzzle to me still. What was the FAIR Act all about? But make one other comment. Jerry mentioned, these other risks that we face, and the two greatest challenges for any insurance program, whether it's subsidized government or private, is moral hazard and adverse selection. And adverse selection occurs when you have inaccurate rates, and I think RMA's done a remarkable job with fine-tuning things and bringing the actuarial science to bear on this, where rates are very accurate, and as a result, we get low loss ratios. But moral hazard occurs if the insured party undertakes some actions after they buy insurance that changes their risk. And the crop insurance program stops before allowing that naturally. And once you get into post-harvest risk and storage and things like that and trying to address things that can go wrong there, you really wade in deep into the moral hazard pond that you don't want to be in. And so that's a challenge also that insurance has to face.
I'd say with respect to the disaster assistance, we almost have a permanent disaster program, and it doesn't run very well. There's a lot of times when a disaster happens that where the damages and the losses are beyond what anything we could recover from crop insurance. So it's reasonable to encourage assistance where there's gaps, but it really should run better. Regarding moral hazard, Barry's made this case many times, and honestly, moral hazard happens when you buy insurance in the market. If there was a private insurance program and it covered farmers, there would be a moral hazard issue there as well.
Always. We all are guilty of moral hazard.
So it's not really a criticism of the crop insurance program to say there's moral hazard. It's a criticism of insurance generally, and frankly, insurance has tremendous value for the economy, for individuals sharing risk. There's an awful lot of businesses, farmers and others, who undertake the risk of going into business and producing and contributing to the economy because they have insurance to help cover some of those risks. Yeah, moral hazard is just inherent in any insurance
It is,
situation.
and let me be clear on what I mean by that. I by no means am I saying this is a problem a special problem in crop insurance, that farmers are committing some immoral act but through moral hazard. I don't think it's fraud and abuse in the federal crop insurance program is not a big problem. It's very minimal. I think farmers want to do the best. They're good stewards of their resources. Absolutely, they want to produce as much as they can. They practice their own conservation and would without heavy subsidies in place. The technological advances that we've seen adopted by farmers, they're very savvy technologically. There's so much happening there. So I just don't want to leave it with the thought that I'm saying moral hazard is some special problem in the crop insurance. If you act differently, the way you drive your car, than you would if you had no insurance at all, that's moral hazard, and we all are guilty of that. It's not an immoral thing that I'm talking about, but it is a problem, as Roger said, for any insurance plan. It is something that we don't want to wade into by covering actions that are man-made, because once you start into that, you have even bigger problems.
Joe, but private insurance contracts they try to prevent moral hazard by having things like deductibles,
Yep.
by having things like co-payments. And the problem that I see with this with some of the developments in crop insurance is that deductible has been shrinking. It used to be 85%, pushed up even higher. If those things are essentially where you're almost indifferent about whether or not you have a loss or sell your product, that's a concern to me. And I agree with you, Barry. No one's going to go out there, plant a crop with the intention of trying to see a failed crop and collect insurance, because that doesn't pay over the long run. One way or the other, you'll pay for higher rates over time. But I do think that the amount of subsidies that are in this program now and the heavier coverage levels, I'm just worried about additional add-ons to cover part of the deductible, to all these other sorts of things that I think do present some problems.
And Vince and I have a paper that's, I think, coming out today, right, Vince? Where we just asked the question, are we trying to remove all of the downside risks from agriculture? Are we going to get to 100% here? We're almost there now, 95%. You can get there with adding on some of the endorsements. What other business sector of the economy does the government guarantee 95% of your revenues?
Thank you all for that. I will make one other point about permanent disaster. The real question, I think, in trying to do this in the Farm Bill is how do you set up the standards for it in a country that's as big as the United States? Because each of these issues for which there has been an ad hoc disaster payment has been very specific. And you know, if you're talking about a program that's going to go all the way from Maine to California and Hawaii, it's very hard to figure out what would qualify for this program. But now I'm going to switch to a topic that hasn't come up here somehow, but we should talk about, which is what are the issues for crop insurance with climate change and cropping practices and greenhouse gas emissions. There's so much talk about this. Some people think, you know, the insurance industry says that crop insurance is a protector for good practices, but there are others who think that the existence of the program means that people are going to plant maybe where they shouldn't because they're going to get insurance if the crop fails. Who would like to talk about that?
I'd like to weigh in on that a bit, Jerry. So I do somewhat disagree with the comment that Joe made earlier. I've been working on a project with a group called the Agree Coalition for several years, and they recognize that the crop insurance is a formidable part of the farm safety net. And we've been working to try to make crop insurance a little friendlier to the adoption of conserving practices. For example, when we started, we were told constantly by farmers that they felt as though the crop insurance regulations actually discouraged the adoption of cover cropping because of some of the rules they had on termination, things like that.
Stephanie, let's explain what cover cropping is.
So cover crop is when you harvest your corn or soybeans in the fall, you immediately plant something like cereal, rye, or field radishes or other crops to maintain a biological cover on the land during the winter, get a little bit of growth in the spring, and build more carbon into the soil before you then plant your spring crop over the top of it, or there's different ways to terminate it. But it adds additional carbon into the soil and protects the surface of the topsoil during the winter. And it's a strongly recommended conservation practice that unfortunately not a lot of American farmers are doing it right now. And part of the notion that we were doing at Agree was to try to figure out ways to at least make crop insurance neutral towards cover crops. We also more recently got data from USDA so we could take a look at whether or not the use of either cover crops or no-till actually helped farmers when it came to the very wet spring of 2019 that led to 20 million acres of preventive planting. And that study came out within the last 2 weeks. And that study found that if you had either cover cropped or no-tilled that land, you were less likely to have actually generated a preventive planting claim in that year as compared to your neighbors who didn't have those practices. So there is evidence. And Barry actually had a study that came out roughly at the same time that had similar outcome. So what we're trying to document is that these practices actually help the yield profile of a farmer, the risk profile of a farmer when it comes to the cropland.
Roger, would you like to comment on this?
I lost track of the original question, but I think it was about the relationship
it is
between crop
about-
insurance and conservation.
Yeah, and its
climate,
impact
yeah.
on climate change, or the value of it in perhaps discouraging climate change.
One of the things that's been brought up is the idea that we're over planning because of the incentive from crop insurance. I think it's going to be hard to find over planning as we go along. As I said earlier, there's some real global food security issues that are come up. We've had very good luck for the last 40 years in terms of agricultural production growth from the fall of the Soviet Union. Market reforms in China opened up an awful lot of production, technological improvements, stability, peace, economic stability, free trade. All those things have had very substantial contributions to agricultural production over the last 40 years in ways that we can't assume will continue. And some of those in ways that have been kind of going backwards in the last few years. So the idea that we should be addressing conservation through locking up lands and not producing is, I think, problematic. We need to have conservation programs that are separate from crop insurance, that are aimed at compensating farmers, providing market-based incentives to farmers to follow good practices, and farmers follow good practices generally speaking as well. But when folks talk about saving the environment by farming less, I'd say they should talk about farming better. I don't know a farmer that isn't willing to talk about farming better, but don't ask them to farm less when food insecurity around the world is on the rise, and farmers take pride in their contribution to addressing that problem.
Joe.
Yeah, no, I just, back to your climate issue, I think no question crop insurance, I think, is an important tool, adaptation tool for crop insurance, for increased yield variability and other things, that attendant problems that would come with climate change. I think, that also means that it will become more expensive, just in the sense of if yields become more highly variable, and due to weather and other things, that rates will adjust and reflect those additional risks. I think the issue, the other side of the issue, of course, is what you mentioned, that is, well, does that encourage producing in areas that you shouldn't? I think that ties back to this whole issue of properly designed insurance contracts, so that deductibles aren't set so low that and subsidies aren't set so high that producers have incentives to take those additional risks. I think that the underlying risk of the market should be determining what gets planted. And just if I can follow up briefly with Stephanie's point, all my point is the rate should reflect the best business practice or best management practices. And there should be, presumably with cover crops, you have best management practices. The rate should reflect that. So we may be in an agreement just in the sense of, let's do that. All I know is there's a lot of literature that suggests that it's not an easy question to resolve. And I think that's what was bothering me, is there might be a political will to say, well, we're going to do it, let's just do it. And I think we need the evidence base to make those changes for discounts and other sorts of things.
And let me add, Jerry, that the AGREE group also supports legislation that's been introduced by Senators Klobuchar and Thune. Follow up on some stuff that was in the last Farm Bill, where we're trying to get USDA to provide more consistent data that links yield performance and adoption of cover crops. That study that I mentioned, we got data from USDA at the field level, but the data on the actual conservation practices on those fields was so sparse that the authors had to go to Indigo Ag to get remote sensing data to determine whether or not those conservation practices were in use, because the USDA didn't have robust enough information on that to make it available for analysis. So we're supporting the Thune-Klobuchar bill that is trying to push USDA to do a better job of pulling those data sets together and make them consistent.
And the nature of the program the nature of the crop insurance program as it is, means that there's a continuous improvement in these contracts, continuous opportunities to revise and update and develop new contracts. And as more data is available, as technology improves for collection of data, there's all kinds of opportunities to make the improvements that folks are talking about. There's an awful lot of most crop insurance contracts have a good number of provisions to require best practices, to address moral hazard, and to avoid some of the problems that could theoretically happen if you don't do that. So one of the real beauties of the crop insurance program is that it doesn't have to just have some incremental change every 5 years in a farm bill to fix something. It is a continuous improvement process. It is a living program that is constantly getting better, and we welcome that continuous improvement.
Now I'm going to turn to another topic, which is the cost of the program and how the money is spent. I'm hoping Stephanie can remember the year, but I remember a year in which the amount of money or the percentages of money that went to the crop insurance agents and to the companies was cut because Congress decided that they had they were getting more than enough.
What?
2011.
2011. Okay. So the money was saved and then it was spent on other aspects of the Farm Bill. The question I have now is, do you think we're in a situation this year where that would be possible? Of course, the industry won't like that idea, but it may come up in Congress, so I'd like to know what our experts think.
Yes, so the 2011 situation is kind of unique in that Congress had given the Risk Management Agency, which oversees the program, the authority to negotiate a new SRA. I think it was in the old
A standard reinsurance agreement.
Standard reinsurance agreement in the 2008 Farm Bill. They took that authority and imposed restrictions and cuts in that new standard reinsurance agreement, which is essentially the standing agreement between the crop insurance companies and USDA. And Congress didn't get to capture any of that savings for its own purposes, which Congress was not happy with. And I was there at the time, and I can document that. So they've actually, I think in the next Farm Bill, told Risk Management Agency that they couldn't do any new SRAs that generated cuts because they wanted to make sure that any changes to the crop insurance program that generated savings would be available to Congress to use as offsets for other programs. So that's a bit of and certainly that would be on the table, I would think, for this upcoming Farm Bill. But as I said, there's pretty strong support for the crop insurance programs in the House and Senate and committees. I think significant cuts to funding for the program are relatively unlikely under those circumstances.
Could I point out these subsidies are paid on a percentage basis?
Yeah.
Yep.
And so they're naturally going to follow prices, right? Prices are high. Taxpayers going to get hit for that much more in premium subsidy. The agents are going to make that much more, and the companies are going to make that much more. So you do need to, perhaps Congress needs to consider some sort of alternative arrangement that puts a cap on some of these issues related to the standard reinsurance agreement. But just keep in mind, everything's done on a proportional basis here, and we have some pretty strong markets now. So,
yeah, I looked at the numbers before this event. The price selection, which is the process by which RMA lets farmers know essentially the guaranteed price that they'll get under a revenue policy for this upcoming year, are 28% higher for corn than they were in 2004 and 21% higher for soybeans than they were 10 years ago. So because of the higher market prices in general, the guarantees are higher, and so all the costs of the program will also be higher this year.
but the A&O subsidy is going to go up with
Yes, sir, because
that.
they are linked to
The
the,
administrative and operating subsidy that's paid to the insurance companies.
yep.
Right.
But
And,
it is
and
capped.
what I remember from that debate, correct me if I'm wrong, is that Congress decided that the agents and the companies were getting enough, or too much and they could cut them, right?
I think,
was that-
I think RMA cut them. I don't
Did
think
RMA
Congress
cut
did.
them? Okay, but anyway, they cut.
Yeah, they were
Yes,
cut.
all right.
They were
Yes, Joe.
capped.
Yeah, I think, this program's really unique in one sense in terms of federal insurance programs. You have things like flood insurance where the government essentially takes all the risk. So an insurance company sells you a flood cover on your place on the shore or whatever. They'll take the losses, and the insurance company just says, okay, I sold it, the policy, I get a payment for that, for a service fee. Crop insurance, in addition to the so-called administrative and operating expense reimbursements, they also share in the risk. And because of the kind of way the so-called reinsurance agreement is structured between the government and the private companies, there is a positive return to the companies. So they are making money by sharing the risk, which is a little counterintuitive, but it's a way that they've kept the companies involved with the underlying risk that they're offering insurance products on. The problem is it's highly regulated industry. If you're a crop insurance company and you see and you want to sell a product to this farmer here, you offer them a rate based on what their yields are. The next company that comes along can't say, well, I'll give you a better rate than them. They pay the same rate. So they can't compete directly on rates. So where can how does a crop insurance company grow? They buy agents. They bid agents to get, by saying, we'll give you a better commission. And so these agents have books of business and other sorts of things. So it's expensive. Now, I look at overall flood insurance costs, it's about 35% of gross premium. I look at federal crop insurance, it's about 35% of gross premium. If you look at A&O or administrative and operating reimbursements and the net underwriting gains, is it too much, too little? One way you could do it, and I've advocated this in other papers, is say, okay, let the companies, let them write rates. Let them compete for business, because then at least if there are a lot of high returns above what the market should be, then they'll pass those on in terms of lower rates. Again, I'm reluctant to say they make too much or too little, but I think there are some ways to sort of let the market decide what those returns are.
Okay. I'm going to switch now to talk about some of the changes in policies that the Risk Management Agency has made since the Biden administration came into power. And if any of you in the audience want to know what these are, just go to the Risk Management Agency website and go to the archive of press releases, and it tells you all the different things that they have come up with in the last couple of years. And so I want to ask what the panel thinks of some of these things that have been done, because these also reflect the things that the various sectors in agriculture are asking. Now, they have done some things to try to make it easier for for specialty crops and organic producers to get crop insurance. This includes what's called a micro farm policy for people who have revenues of less than $100,000 a year. It requires less record keeping. There are other things, but I wonder, what do you think about specialty crops and organics? Because those industries are asking for more crop insurance coverage.
Well, that was a huge issue and still is a huge issue. The crop insurance program is largely benefits, and certainly the liabilities are focused on the major row crops. Corn, soybeans, wheat account for, I don't know, probably 2/3 of the acres, well, excluding pasture and rangeland, which we'll talk about, is a separate category. Among cropland, corn, wheat, and soybeans account for the vast bulk of the insured acres in the United States. Specialty crops, there's dozens of specialty crops that have crop insurance policies. They're almost all yield policies only. They don't have revenue coverage the way the row crops do. in part because of the way the prices are established are mainly under contract and not in open markets. And then there are a lot of smaller specialty crops who don't even have crop insurance policies, and they have to rely on the NAP program, which is a less lucrative, really standing disaster program that the Farm Service Agency runs. So there's quite a gap in the attractiveness of coverage for row crops as compared to special crops. And the organic folks have been complaining for years that the premium that they receive in the market for their practices aren't necessarily recognized in the coverage that they receive.
But there is a type in practice now. RMA
Yeah,
is introduced.
it took a while to get there, but yeah.
There's a what?
There is a practice type for organics for every commodity, just about. I mean, wheat has an organic practice, corn has an organic practice, soybeans and so forth. That not specialty corn, but mainstream corn. And there are arrangements that are made through contracts, looking at grower contracts for some of these to insure at the higher price. There's a lot of things that RMA has done to address this. I mean, I know the industry doesn't feel like it's enough, but it's growing tremendously. I mean, and every practice that's added, that's a huge administrative addition to things for RMA. So
Yeah, I'm not up to date with what they've been doing on organic because I haven't worked on these issues directly since I left the Ag Committee. So thank you, Barry.
The department's efforts to provide coverage for all sectors of agriculture is what we were talking about. But the program is flexible. It offers opportunities. The department now is authorized to explore new programs in the same way that private developers can come in, like Barry can come in and offer a concept and even get assistance from the department to flesh it out. So, organic is an important part of agriculture, the way the corn and soybean producers important parts of agriculture, and the more that crop insurance can be developed to provide that kind of risk management across agriculture, maybe the less need there is for these disaster programs.
Isn't one of the big problems in trying to do the crop insurance programs for these small acreage crops is that the smaller the acreage, the harder it is to be actuarially sound? I think that is an issue that everybody, Congress and RMA,
I don't know
have to deal with.
I mean, there certainly is a crop, if you were looking specifically at say, organic, corn or broccoli or something.
Yeah.
But
it's going to vary from year to year, but that's true whether it's organic or not. I mean, I think the actuarials are still, the real question is, okay, to the extent that it's much like we were talking about with cover crops or whatever, if you're not using pesticides or if you're not using that, how much more variable are your yields? And there are some who will say, well, it's not at all or whatever. But again, the point is that what RMA has to try to do is set those rates so that it is actuarially sound. And with better data, with the longer time series, that will improve. But I think it's between that and sort of setting the underwriting rules. That is what farmers have to do to comply to those so-called best practices. Those are the key things with organics.
But unit size does matter in the rate that you pay. How you choose to insure multiple units can have a big effect on the rate that you pay. So there is some attempt to address the size risk trade-off.
Yeah, and for a lot of the smaller special crops, the reason they don't have a crop insurance policy is that RMA's not been able to get their hands on enough data to actually design a policy for them.
Data is an issue, and there's some economies of scale for the development process. So that's one of the reasons why I think the department is making efforts to help develop products for smaller segments.
Yeah, well, part of the problem was that in ARPA, we put in a restriction on RMA actually being
Yes.
directly involved in developing products.
right.
But they can commission.
But they removed that in
they can
2014,
Well,
I believe.
it's mainly 508H products that
Yeah.
have been
Yeah.
the big thing. With that is, and sorry, Jerry, for the jargon, what this particular provision is in the Federal Crop Insurance Act is it allows private submitters to come in and say, here's an insurance policy we think farmers would like to have. And if the board of directors for the Federal Crop Insurance Corporation approves it, then that insurance is available, there's insurance subsidies available and other sorts of things. Prior to getting approved, it's sent out to experts to look at the actuarials, to look at the underwriting rules, all of those sorts of things. And I think that oftentimes is where the problem is, not blaming the reviewers, but the reviewers coming back and saying, look, there's not a lot of data here. So we're really reluctant to say these rates would actually cover losses.
Yeah.
So what RMA typically will do is, or what oftentimes happens before that contract comes out and is available to the public, is there will be some risk factors built into the rates or whatever that oftentimes, by the time it comes out, producers then complain that the rates are too high. But I think that's just the problem of not having adequate data on some of these products.
Yeah, I think it's also worth mentioning that the private submitters to these products can get reimbursed for their expenses, and in fact, they can actually get an advance payment to cover their costs, and then they get the rest of it reimbursed if it gets approved. So there is some incentive for these private entities to submit these proposals.
And if I understood your book correctly, the risk management agency can commission
Yes, they have that
developers
authority.
to come up with
And
something.
every farm bill since the '08 bill, you've seen a section of the crop insurance title, which is a list of pilot programs and studies that Congress wants RMA to undertake. So that's another way of going about it as well.
And it's some of the experts on this get a little bit spoiled when they're looking at markets like corn and wheat and soybeans, because there's huge liquid contracts, futures and options contracts. You can use some formulas to generate actuarially sound rates for those things. It's cookbook, because there's so much information. So the challenge is to remind these folks that there was a time when we developed crop insurance on much less information than that, and that can be done for other commodities as well.
True, but the last thing we want to do is develop a product that's poorly priced, that is effectively a subsidy, that causes a very small market to all of a sudden grow a lot. Because then you'll have a collapse in prices. And interesting, there have been a lot of specialty crop producer groups that have actually opposed crop insurance for that particular concern. Now, I think that's changing a lot, and I think, again, your point, that better data, and yes, it is certainly something that is a luxury for big row crop agriculture that has long histories of these sorts of things, and better efforts need to be made, but that is a concern.
Yeah, I think I remember the potato industry coming to Congress in '02 and saying, can you please put a prohibition on developing a revenue product for our policy, for our crop in the bill? And there was one for many years then. So yeah, there are active opponents of this kind of approach among some of the specialty crop groups.
I feel compelled to bring up a crop that has so much trouble in recent years, because I don't know if this crop insurance has been developed for it yet, but what about hemp?
Hemp has coverage now.
It does have coverage, okay.
I can't think because of 508H
Well,
process.
no, it's because of Mitch McConnell.
Yeah, no, I was going to say, I can't think of too many crops or commodities that don't have coverage now. I mean, and that's what I said, this process sounds great, and it's you get the data and you have to look at the actuarials and these different things, but that costs money to do the review. It costs taxpayer resources to do it, and as I said, it's birthed an industry in and of itself that does these things, and
Yeah, cottage industry is like.
yes, I called it cottage industry, and it's I think there are plans out there. Joe would know better than I, but there's some that the total premium probably doesn't match what the cost to develop and maintain
I think
it.
there's definitely some products like that. I mean, some of it is, one could argue in the grand scheme, well, that's what, people offer products sometimes. This is like any business. You offer a product, it fails, you drop it, whatever. But I think what's significant here with a lot of the 508H process, these aren't insurance companies.
No.
These are small niche groups that are will talk to producer group, find out what they want, oftentimes develop a product, then go to the producer group and convince them they want it. But it is, I don't mean to be too critical of it. Well, no, I guess I am critical of it.
Yeah, no.
I think I'd rather see this coming up from insurance companies and things like that.
In fact,
but-
I would guess, Joe, that the majority of the submissions do not initially involve crop insurance companies at all.
No, they don't at all. No, in fact, that's a big concern because oftentimes they include a lot of, by the time the board gets done with it and the reviewers and others, they add all these underwriting requirements that guess who absorbs the cost of that? It's the companies, not to a limited degree the farmers, but companies.
Yeah, in a few minutes, I'm going to switch to questions from the audience. I just want to remind those who are watching online that you can submit questions to benjamin.goren@aei.org. That's benjamin.goren.
With a J.
Benjamin with a J, yes. benjamin.goren@aei.org, or at Twitter using the hashtag AEI Farm Bill. Just a couple more questions that I have here. Joe mentioned the livestock program. It seems to me that the dairy industry is moving towards insurance. They've had such a problem developing a dairy program through the Farm Bill. What do you think about the dairy, the livestock programs in general that also cover swine and cattle producers, and the dairy program? Anybody?
I have not kept up with what's been going on. I remember in the Ag Risk Protection Act that I worked on in 2000, we actually capped how much could be spent on developing and marketing livestock products. So they were very limited until relatively recently. I think that cap got removed in 2014.
$20 million cap.
Yeah.
And now it's several hundred million
Yeah.
in terms of premium and
And,
cost too.
and they're covering not mortality, not deaths of animals, but they're covering sort of the risk of feeding costs exceeding the price that the
They're repackaging market options.
yeah,
That's all it
essentially.
is.
So it's really only price risk or input price risk that they're insuring against, not any natural cause of loss, which is the main
And again,
focus.
because this program was capped at $20 million, the way and so in
Was.
2001, 2002, the products that were coming through the door at that time were essentially price-based contracts. And the board said, okay, look, $20 million isn't a lot of money. That essentially covers what the insurance companies were going to pay them for delivering this product, so no premium subsidies. And admittedly, until some of the margin contracts came along, and they actually sold without subsidy. The big thing holding them back was the $20 million cap because RMA could only go so far. But now, it's Katie bar the door, I think, in one sense, since what, the Bipartisan Budget Act, was that the one that brought it in, allowed?
Maybe was it the 2014 Farm Bill?
No.
Wasn't it 2014?
It's within the last 3 years or so.
Okay.
I think it's Bipartisan Budget Act. Got rid of
The cap.
the cap. And it's, again, as Barry said, they're largely price contracts. There are some margin ones that have feed components in there too. But essentially they're derivatives that are based on underlying futures and options contracts. So arguably you could package these yourself and get these. Yet now we're subsidizing them at a pretty high rate. And that again is probably, I'm not singling out livestock here, but to me that seems like these are pure price contracts. And for something that really does exist out there. And so why are we competing with that?
And
Or why are taxpayers providing money?
dairy has its own insurance program.
Yeah.
We have margin.
Which is separate from
There's a
does
couple.
not run by the risk management agency.
We have crop margin coverage now too.
Yeah.
Let me ask one last question before I turn to the audience, and that is, RMA it seems like it's making an enormous effort to try to educate underserved producers, which they would define, I believe, as minorities, women, and also some of these organics and specialty crop producers that don't have as much coverage as they say they want. Do we know anything about how this, what do you think about these, this program to try to educate these people? And do we know anything about how it's going?
Well, there have been resources available to RMA to help those underserved producers since the 2000 Ag Risk Protection Act. I don't know, I've never seen any analysis of how effectively those resources have been used, but that effort has been underway for a long time.
Joe?
Last month, we had this, on this stage, we had this whole issue on structure of agriculture and sort of, I think that's what, in one sense, you have to look at. There's a lot of, if you look at participation in this program, these high numbers that I alluded to, those are all area-based numbers. They aren't farms.
Yeah.
If you look at the number of farms, actually the number of farms that actually are using insurance is much, much lower.
Yeah.
And that's largely because of these small farms. The argument, I would say, Jerry, is yes, some of it may be a lack of education. They may not know about it. The other thing is that there are probably a lot of other ways they can offset their risks. Now, again, I get the point that you have organic farmers and others who are saying, gee, we wish there was an insurance product that better suit our needs. But if you're talking about a farm that has a limited number of acreage under cultivation, it may not pay to buy crop insurance, particularly if you have a lot of off-farm work, other sorts of things.
There is one other factor which has been discussed, and that is that minority farmers may have a distrust of the government, and perhaps these programs can make the crop insurance program more trustworthy.
Well, I work with an African-American farmer in Georgia who raises special crops as well as row crops. And I had asked him a few years back about the whole farm revenue program, which was, I think, made in the 2018 Farm Bill, or maybe it was the 2014 Farm Bill. He said that it wasn't attractive because it was a very complicated program for an agent to sit down and explain to a farmer, and that there just was not enough incentive for the agent to take the time and energy to do that. And so that was not being promoted among minority farmers. He lives in Southwest Georgia. And so it just wasn't being marketed very effectively.
Among any farmer.
Yeah,
No one
but I'm
buys
talking
whole
about-
farm. But my point is on whole farm it is very, very complicated.
They're talking about a program called Whole Farm Revenue, in which you put the whole farm into the one policy.
Yeah, it sounds simple in practice, but
it's hard
in
to
theory.
but in practice it's
Yeah.
very difficult.
I believe we have a question from the audience over here. Please identify yourself.
Hi, my name is Steve Perkins. My family owns a farm in West Texas that we've had for about 100 years, literally. And so we mainly grow cotton. I remember 50 years ago, we used to have a great cotton crop and things were pretty good. And around 2000, it seemed like we stopped growing cotton as well. And so we started getting crop insurance, which we received off and on for probably 20 years. And ultimately, what we ended up doing was going into a conservation reserve program, which is not exactly what you're talking about, but I see other farmers around us doing the same thing. And I don't know if it's climate change or it's people like me who don't live on the farm anymore, who don't want to work that hard, or exactly what it is, but there are more people getting into the conservation reserve programs. I don't know where that fits into what you're talking about exactly, but do you see that growing? Do you see it not growing? I'm wondering where that fits into things like crop insurance and disaster.
It's
Crop insurance is
capped
really
at
big in-
27 million.
Yeah,
What's that?
I
It's
don't,
capped at 27 million acres.
I don't think they're at 27 million this year, though. They're like 20,
Conservation
24.
Reserve Program. But to your point about West Texas, I mean, it is heavy participation there in crop insurance. It is very expensive. You'll see producers won't be covering at quite the same levels as you get with some of the row crops, say in Illinois or something, just because the rates are so high. But yeah, no, absolutely. And then particularly with, I mean, like, was it last year with such a large amount of abandonment?
Yeah,
and
there was a lot
everything?
last
I mean,
year.
it's just an expensive crop to insure.
Loss ratios have been traditionally very high there,
Very
too.
high.
Well, I
Yeah,
mean,
that's right.
and cotton was one of the first crops to be insured back with the early program in 38, and that was part of the reason why the program got dropped for a couple of years, because it performed so poorly.
Not blaming you.
No, you weren't around in 1938, I'm sure.
This gentleman in the back.
Thanks for the great discussion. Dan Rato with the Breakthrough Institute. You talked quite a bit about how many insurance reforms propose to encourage adoption of cover crops or other environmentally beneficial practices. I'm curious, from my perspective, it's very important also environmentally to increase yields and productivity. And Joe, you briefly mentioned how insurance might affect yield variability. But I'm curious from really all of you, what you see as the evidence for insurance programs affecting yields and how reforms might be implemented to further raise yields, or if there should be any such reforms.
Let me start. I wanted to clarify. I think because of yield variability, that creates a demand, a demand to protect yourself from low yields. I think in terms of productivity, that's sort of a separate discussion. I don't think the crop insurance program should be any way involved with trying to increase productivity. I think that should be done via research and development monies and other sorts of things, both public and private. But and Vince, if I'm not mistaken, you have a session on that coming up? Yes. Okay.
I think it's nice to see that there's a growing consensus that we need to spend more money on public research in agriculture, and that's the foundation for productivity growth. Really, I mean, it's the private companies can take it that last third or 2/3 of the way, but the fundamental research at the universities is really critical.
Yeah, I agree with both Roger and Joe. I mean, crop insurance is a risk management tool and largely a transfer program, as are the commodity program. But spending on ag research is an actual investment in the productivity gains that we need to see in agriculture, not just in the United States, but globally, because we are falling behind where we need to be. Virginia Tech puts out an annual report they call the Global Ag Productivity, or GAP report. And the numbers last fall, what we need in order to feed a global population of approaching 10 billion by 2050 is 1.73% annual ag productivity growth rate, and where we are right now is 1.12%. So we're more than 30% below where we need to be.
And research pays great dividends relative to the cost, and I'm not sure it's gone up in my professional lifetime. It seems like it gets shrunk a little bit every year, and the public sector's having to pick up so much more of that, or the private sector. I mean, and of course the benefits are there, but they're not as widely spread when it's private industry.
And the private sector tends to focus on the larger crops, so they spend most of their money on corn, soybeans, cotton, the ones we've been talking about, and some of these other crops and other kinds of activities. You really need the public sector to step in.
I'm going to ask a question that has come in from the audience. What are the trend lines related to the quality of the crop in all this data?
Well, that's been an ongoing issue in crop insurance, is to how do you compensate the farmer for loss of quality, not just a loss of yield. And I'm not sure it's ever been resolved to the satisfaction of the producers, but it is something they look at.
I think it depends on the commodity. There's some commodities where that's much more quantifiable than others. If cotton and tobacco, for example, some things are a lot more quantifiable because there's a lot more detailed grading and evaluation than
Staple length
some
and
others.
things, yeah.
But largely the quality stuff is driven by the market itself. I mean,
Right.
If
Right.
you come in with poor quality corn, you're going to get docked at the elevator. I
Yeah.
mean, I think the crop insurance is just trying to compensate to a degree that some of it may have been by a natural process or whatever. But again, it's one of the moral hazard, best management practice issues that we were talking about. I mean, I think you want to have an insurance product that is encouraging you to produce the best quality crop you can.
And what they are able to measure for the major row crops are kind of physical quality, like dockage, protein content, things like that. More intrinsic nutritional stuff is not going to be covered at all because they just don't have the capability to measure that on a broad enough scale to build that into a program.
Do we have another question from the audience here?
Yeah, thank you, Jerry. This is Susan Keith. My question is about the insurable yield, and I would like to know the panel's opinion about yield exclusion and also prevented planting that enables a producer to get an indemnity without affecting that insurable yield for the following year.
Well, prevented planting has been a major problem because it's very difficult for an adjuster to validate whether, they're not weathermen necessarily. And so the concerns of moral hazard have been higher related to prevented planting. But we did see, was it 2019 or 2020 when we had 2019, we had all of this excess rain when it really did matter. And so there is a question, how much cost do we reimburse when the farmer has not actually got to planting? But it's an issue. And yield exclusion, I mean, that does not affect their rate because that's done off of the rate yield. But it does allow them to exclude bad years. And I think there's a lot of actuarial questions surrounding that. I don't know.
I think prevent plant is important to not incentivize folks to plant when there's no point to it. And I think that you want to establish a history that represents what the actual likelihood of yield would be in a coming year. So I think it depends on the contract, the commodity, the situation. And I think there's a lot of variation within the program on how that's addressed.
Yeah, I think as we go forward over the next 10 and 20 years, we're going to find out that 2019, which is a year when we had almost 20 million acres of prevented planting, is not going to be as anomalous as it appeared to have been 5 years ago. And there are going to be more, areas in spring that you simply can't have plant a crop in time and get a decent yield, and you're going to rely more and more on that part of the program.
Unfortunately, and Barry has a lot of good research on this, there are just areas of the country where are very prone to prevent plant or, have early flooding. And I think of the pothole region up in the Dakotas and other places that suffer a lot of losses. And the question is, okay, are you rating them properly? Is that something if farmers are collecting, it's a terrible thing. And I agree with Roger, you don't want to encourage planting if you know it's going to be a failed crop. So how do you balance that? How do you get the rates right on that? And that's tough.
And that is something in which, if you change it, there will be political pressure. Not for it to be changed. Just to say to the audience, in case anyone doesn't understand, prevent planting refers to a farmer not being able to plant a crop and then getting a payment because planting has been prevented.
Right, but only covering those costs that you would have incurred up to that point.
Yeah. I have a question here from the audience that kind of brings together things that we've been talking about. We've sort of made these points, but I'm going to ask it because maybe you want to pull this together. Some lawmakers and people within the crop insurance industry maintain it cannot be changed to adjust for climate initiatives. But crop insurance is paying out for persistent crop losses, such as due to drought, and ad hoc disaster aid is on the rise to pay for losses as well. So how can the program be changed to incentivize producers to be more resilient, diversify their rotations, protect their soil?
And that's the goal of the work that the Agree Coalition is to try to figure out ways to adjust the program to make it more friendly to some of these conservation practices that we believe, and then that study that I mentioned show that if you do these practices, your yield variability has the ability to decline and generate less prevented planting claims. So, and maybe not directly encourage, but certainly recognize that these practices have that impact on the program is important.
Roger, how would Farm Bureau feel about that?
I don't think we have any problem with increased flexibility. The kind of things that Stephanie's been working on to increase the flexibility for things like, yield, applications, split applications. and
Fertilizer, yeah.
some
That
of
was
the-
that was an actual crop insurance endorsement that the Agree worked on and got approved last year.
No, I've got to mention
If
this.
you- if
You're
you make-
talking about split application of nitrogen, right?
Correct.
That was the one question I decided was too nerdy for this conversation.
But flexibility, increased flexibility is always welcome, and giving, we risk at times, we can risk, I think, if I understand correctly, the problem you're addressing is the way that the provisions in a lot of these contracts to address moral hazard dictate crop practices in ways that maybe take away some of the flexibility for conservation practices. And it's good to recognize where there's benefits from providing more flexibility to farmers to do different things without them losing out on the benefits of the crop insurance program.
I think Congress actually had to tell RMA that conservation should be considered a good farming practice, because they're such a bureaucratic and inherently conservative organization that they were very reluctant to move in that direction. And I think it was actually statutory language in the Farm Bill that said, yeah, conservation tillage, for example, is a good farming practice.
And that's very,
Farmers use conservation tillage
Yeah.
now. I mean, 60% of the land is farmed as conservation tillage without subsidies specifically
Yeah,
for that.
exactly. But cover cropping, not so much.
Well, cover cropping is what, about 4 or 5%?
About 3.
3. So remember, though, that it costs money to plant.
It does.
And burn that off as well. It's not free.
It isn't.
And I think farmers have been very uncertain about what the yield effects from that are. I know Agree says it improves yields, but I would say, well, we don't need to subsidize it then. If it's improving yields, farmers will adopt it anyways.
I think we need to look at what is the time frame, because certainly some farmers have the experience of a yield loss in the first year or two of adopting cover cropping, but at least some evidence suggests that over the long run that doesn't persist.
Our time is almost up, so I'm going to ask a futuristic question. The latest trends in agriculture are urban agriculture and controlled environment agriculture, which means farming in buildings. Do you see a role for crop insurance in these?
I've done a little bit of looking at urban agriculture, and one of the things that I find that they still are really having difficulty with is the energy costs associated with urban agriculture. That those, unless they can find a way to really address those, that kind of production will never be competitive with conventional open air agriculture.
When will cannabis be insurable?
Well, that's a good
the-
question. Make
that's
sure he heard that. Barry asked, when will cannabis be insurable?
Oh,
There is actually private insurance for the cannabis growers.
Yeah.
Which I'm surprised to find, but it's against things like theft and.
well, the problem is that cannabis is still a legal substance under
Exactly.
federal law.
Yeah,
So
yeah.
as long as that's the case, you're never going to get
Well,
it
I
in the
was-
crop insurance
well, I was-
program.
These are in pretty controlled environments, so the risks, the agricultural risks aren't probably nearly as great as electrical outages or the risk of a fire or
Which is not a natural
or
cause of
theft.
loss, right?
Which would not be a natural
Natural cause of loss.
certainly not insurance.
I
Well,
see.
failure of irrigation is an insurable loss.
That's
I don't
true.
know if
That's
the
true.
failure of electricity would be. It's a good question, but we're a long ways away from that, I think. But just mention it in jest, really.
Yeah. First, you got to legalize it and then worry about the crop insurance piece, I think.
Is there anything that anyone would like to say in 30 seconds before we end today?
I want to mention 2 things we haven't mentioned. One is we do have a national debt of what, $33 trillion now, and we're bumping up against that debt limit, which probably isn't a real limit after all, but there's some concern and talk about that. And I would encourage everyone to look at the so-called Inflation Reduction Act, which I don't think it's necessarily going to do that, but there's a lot in there pertaining to agriculture, and we're talking $1 billion here and $1 billion there. So there's a lot happening there that we haven't even mentioned today.
Yeah, not on crop insurance, though.
No, not on insurance conservation, really. But,
Yep.
but it's very relevant because climate change is woven through the whole thing.
Yeah, there were roughly $40 billion in the Inflation Reduction Act that will go towards encouraging adopt climate smart practices, both in crop agriculture, and also there's a fair chunk for forestry to do more for fire prevention, that kind of stuff. So that's what that money is focused on.
And we want to save crop insurance. We want to preserve crop insurance. The Farm Bill, we don't need big changes in the crop insurance. We just need to keep it. The program will take care of itself.
I think you ought to use the opportunity, if there's a budget thing, then you ought to look at duplication. And if you think you're duplicating coverage on price and other sorts of things, then I think that might be a good place to look. But other than that, Jerry, I'd say look for 50s contemporary architecture things after split yield applications. You probably have places you go.
Yep, and be very wary of referring to the 2023 Farm Bill, because we're very likely to be a 2024 Farm Bill. So I prefer to use the phrase upcoming, and then you don't have to be year specific.
I agree.
Yeah.
I agree with Stephanie about that. And I think we're at about the closing time now. So what I would do is after I would thank everyone in the room and online for listening. I think it's been a fascinating discussion of a very complicated topic. And I think everyone who is here or online now deserves to go and have a great lunch. So thank you very much.